This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series of financial repression, I have John Butler joining us this morning from London. John is the publisher of the Amphora report, author of the book The Golden Revolution, and is also, when he's got some extra time, Chief Investment Officer at Amphora Atom Capital. Welcome, John.
Thank you, Gordon. Pleasure to be here.
John, maybe we could just kick it off right away with you giving our listeners a brief overview of your background and Amphora Atom.
Yes, I mean, I worked for major banks, investment banks, for many years in New York, Germany, and London. Those banks included, among others, Lehman Brothers and Deutsche Bank. At both of those firms, I was a managing director. My responsibilities were for interest rate, currency, and commodity strategy, not just in a general macro sense, but also in a more relative value sense. That is, we are really trying to uncover very, very specialized arbitrage opportunities, for example, in those markets. But it was really during my time working for these firms and seeing what was happening on the inside, especially in the mid-2000s, I just saw ample, I guess, anecdotal evidence, to characterize it best, that what you would expect to be natural self-discipline and internal self-regulation and risk-taking activities, that was being pushed aside, and that there was a general huge industry bias towards excessive leverage, excessive risk, and it was my strong opinion, not that Lehman Brothers would fail necessarily, I wasn't predicting that, but that the industry was in for a major crisis, if only a period of lower profitability ahead. So I don't want to say I predicted the crisis, although I did see certain aspects of it beginning to form in the background. And when the crisis did hit, I therefore felt I had a better understanding than most industry insiders regarding just what had gone wrong. Also, I previously had a background in alternative/Austrian economics, which also gave me perhaps an interesting perspective that was very useful as the crisis began to unfold. And that led also to a personal decision on my part to try and work more independently and to start my own firm, because I feel today, as I felt then, that the financial industry as we know it will never recover to the way that it was, will never be as profitable, at least not on a sustainable basis as it was during the big bubble years, and so we need to find alternative ways forward now.
John, you define yourself as an Austrian economist?
I would, yes.
At that school? Yes.
Absolutely, and in fact, my first exposure to Austrian economics was when I was only about 14 or 15 years old. I had a very enlightened history and economics professor in high school who really insisted that I read Hayek and some of the other classic Austrians. And while I didn't necessarily take it all in at the time, as I went about my career in finance, these thoughts, these ideas, remained in the back of my mind and really began to come to the fore in the mid-2000s, as I described a moment ago, and really helped me to place what was happening in its broader theoretical and historical context.
Yeah, try and find somebody like that at the college level. He was a high school teacher. It doesn't seem that you're allowed to be a college professor and have any thoughts on the Austrian school. But I don't want to, I won't digress here. We're here to talk about financial repression. And as part of our series, how would you explain to our listeners what the macroprudential policy of financial repression is? In your words, John.
There's a broad definition and a more narrow one. In a broad sense, you could argue that financial repression is simply any policy that constrains the ability of the financial markets and, of course, investors, participants in the financial markets, to take rational actions to invest and diversify and manage the risk of their investments as they would personally prefer to do. That's a very general definition. More specifically, in the way that I think the term is applied in this day and age, going back to the very seminal paper by Carmen Reinhart of
Yes.
I believe either 2010 or 2011, I forget exactly when it came out. It refers to a kind of a specific toolkit of policies implemented by governments which indirectly confiscate the wealth of the private sector and basically move it to some combination of the public sector and or large too big to fail financial institutions. So you could look at it in the very broad sense or in the more narrow sense in which it is more commonly used today.
Yeah, in her paper, at least one of the economic working papers, it was specifically referred to as a liquidation tax. And that,
yes.
that is a stealth way of reducing the government's debt structure over a protracted period of time using negative real interest rates. But I thought that was only the once it appeared, and after that it was removed. Now, John, financial repression is not unique to America. It seems to be prevalent now in most of the developed worlds with significant debt structures. You do, I'm sure, a lot of traveling. How broad-based is it on a global basis in your mind? And do you have any examples?
It's extremely broad-based, and in fact, you have to look very carefully to find countries that are not actively pursuing it at some mix of financial repression policies. And they tend to be quite small economies as well. They tend to be quite small, quite open economies that are heavily dependent on international investment. If you're trying to attract international capital, you need to treat savers well. You need to treat investors well. But your larger economies that don't have quite as much of a need to attract international capital, or in the case of the United States, may be dependent on international capital, but are so big that international investors invest in them by definition. These are the economies where financial repression is most in evidence in the US, in the Euro area, in Japan, and to a lesser extent, or I should say to a similar extent in the UK, I should have mentioned that, and then to a lesser extent in other major developed economies.
Well, the winners in financial repression, well, the losers are savers. And you mentioned in economies where they depended on savers, so they would have a problem here because the winners are really the government, those that have leveraged debt, and I would also refer to as the primary dealers who get first use of money. Is that right for me to say that?
I think that's correct, and that's why when I discussed how it appropriates or confiscates resources from the private sector to the public sector, I mentioned too big to fail financial institutions, because when you get into these situations where excessive leverage, private sector leverage, threatens to bring down the system, the interests of those large private institutions and the public sector coalesce into the same common interest. And that's why, for example, central bank independence historically is always compromised when the financial sector in general gets into this perilous state of affairs.
John, why is there realistically no way out but to expand money and credit and thereby debase currencies as a store of value, which propagates financial repression? What is the core issue here? Too much debt?
I wouldn't agree 100% with that statement, because if you look at the early 80s, for example, at the early Volcker era, there was this multi-year period of very tough economic and financial love, as it were, that did succeed in deflating and deleveraging the system. Now, that said, the process was never completed. And that said, you could argue that what followed some years thereafter, the Plaza Accord, the Louvre Accords, the '87 stock market crash, the real estate S&L-based bubble, that all of these things would not have occurred in the way they occurred had Volcker finished the job properly. However, fast forward to today, where there's that much more leverage in the system, The financial sector relative to the broader economy is that much larger than it was. It's certainly less solvent than it was. And the U.S. Dependence on foreign capital is that much greater than it was. You put all of these things together, and the supertanker that Volcker was trying to turn around. He never fully turned it around, but the supertanker he was trying to turn around was a much smaller supertanker, whereas today that supertanker is so large you simply cannot turn it around. There's simply no way to do it now without resort to just fundamental currency debasement. There's no other way out. Now, exactly how that comes about, the short answer is I don't know. I speculate in my Amphora report based on educated historical guesses how it might be done. But devaluation versus real assets is the key element of the endgame that everyone needs to be aware of.
But if we have a race to debase and they're all kind of devaluing together, is it evident? Is it obvious to see the devaluation? Maybe that's
it's less obvious.
Way of asking the question.
It's less obvious, and that's why I stress a devaluation relative to real assets.
Exactly.
The so-called currency wars that arguably got going back in 2009, 2010, coming out of the financial crisis, those currency wars continue to this day. There have been periods of ceasefire, but then there have been periods of escalation. And in fact, we're seeing one of those now with the Bank of Japan once again very deliberately trying to protect their market share, as it were, in the global economy by debasing the yen. It's extremely important. Japan competes in particular with Germany and South Korea for the global high-tech manufacturing export market. And it is essential for their economy that they retain that market share. In a way, it's the only source of economic strength they have left. They used to be big net savers. They're not anymore. They used to be competitive in a large range of export industries. They're not anymore. They're, in fact, now really only competitive in this area of high-value, high-tech manufacturing exports. So this is, again, these currency wars, these periodic escalations, they do continue, but it really just means that everybody tries devaluing against each other. Now, some argue that is a zero-sum game. I argue in my writings it is a negative-sum game. And the reason why it's negative is because what the policymakers don't realize they're doing by trying to devalue versus each other is that, in fact, they are unseen, behind the scenes, undermining the very credibility of the concept of unbacked fiat currencies generally. And you see the BRICS, among other economies, increasingly wary of where this is going. The possibility that all major developed economies' currencies are simply all going to be chronically weak and no longer represent reliable stores of value. Hence, the huge push by the BRICS in recent years to diversify not only their fiat currency reserves, but to diversify into gold, to diversify into oil fields, to diversify into real assets generally.
I don't think most people, John, fully understand the level of that diversification. We had Nick Bereshoff on last week, and Nick was saying that he believes the Chinese holdings now are close to 5,000 tons and officially reported at 1,000 tons. These are big moves, with Russia as buying all the India, the BRICS in general. So you've got the one side of the house that is not debasing their currency, accumulating gold. You've got the other, and I'll refer to them as the currency cartel, where four currencies that control fundamentally 90% of the trading currencies in the world. And if they debase together, it's very hard to see where the flight is and where the debasement is, unless you denominate, as you correctly say, in something like gold or some kind of hard asset. So, but John, the question then is, how does an investor protect themselves, and maybe more importantly, take advantage of an investment opportunity here?
Well, remember, the whole point of financial repression is to make it difficult, if not impossible, for the investor to protect themselves. So yes, it's a very good question, and we have to think outside the box. We have to get creative. And this is where we simply have to fall back on the only so-called free lunch in economics, and that is diversification. The problem is, in a world of financial repression, the way you diversify yourself is very different than the way you diversify yourself in a world in which financial repression is not an issue. So if they're absent financial repression, a typical portfolio of diversified financial assets across stock market sectors, across bond markets, credit and government, across countries, this should work. And this should provide a sufficient degree of diversification. But as we're discussing today, we don't live in that sort of world. We live in a world where the degree of diversification we can achieve in major stock markets, bond markets, is limited because ultimately all of these assets are denominated in the very currencies that need to be devalued and debased in order to get the governments out of the huge debts that they've run up. And so the problem you're going to run into, of course, is that the value of bonds will decline as the currencies decline in value. In nominal terms, bond values may not decline by much at all, but in real terms, real purchasing power terms, they will. Even stock markets. Yes, corporate profits can grow with inflation. The problem is this: as inflation picks up, it erodes the quality of real growth, and therefore erodes the quality of investment in the future. It erodes the quality of corporate profits themselves. Hence, in the 1970s, for example, the decade of the dreaded stagflation, yes, stocks did better than bonds, but in real terms, stocks did poorly. Why? Because in nominal terms, yes, corporate profits were rising, but in real terms, in real purchasing power terms, they weren't keeping up with inflation. We're going to see a similar thing this time around. And so you've got to get into real assets. You've got to get in, if you do hold shares in industries that have strong pricing power, where there are bottlenecks in supply. Think infrastructure. Think food, clothing, and shelter. Think staples. Think the sorts of things that will continue to have a residual degree of underlying demand, even in the event that the quality of growth in general is very poor. And then, of course, there's gold itself. There's also silver itself. In fact, at current ratios, you could argue silver is the better value than gold. Take a look at history, for example. So there are a number of things investors can do to diversify, but then they also need to think in terms of jurisdiction. Sadly, one of the tools in the financial repression toolkit are various ways of trying to, say, force investors to invest in certain types of assets, or to prevent them being able to invest in certain types of assets. I would not put it past the U.S. government, or other governments for that matter, to restrict ways in which investors can access gold or silver, to restrict ways in which they can invest in vital infrastructure industries, or to maybe place punitive taxes on these sorts of holdings. So try to diversify also by jurisdiction, by type of account, custody of account. Think across all of these dimensions. You don't know exactly what assets will be best protected in what way, in what location in this sort of environment. Think as broadly as you can.
John, you mentioned obviously the hard asset element. We're watching commodity prices plummeting for at least last 90 days or longer. We're talking about currency being debased, but on the other hand, we're watching the United States dollar breaking a trend line that goes back 30 years in the degree of strength. Could you rationalize what's going on to our listeners that would counter what we're saying here? But there is a reason.
I think there are three explanations at present for why the dollar is as strong as it is, and it's related to why the stock market is holding up as well as it is, and why commodities prices are as weak as they are. Let's go back to the beginning. In a world in where the money supply, it all begins with money, in a world in which the money supply is relatively stable, then of course assets compete with each other for relative valuation gains or losses. Obviously, if the money supply is growing, in theory, all prices can go up. But when money supply growth slows, that is not possible, and you find that if something is rising in value, something else has to be falling in value. And indeed, over the past 6 months, there has been a noticeable deceleration in the rate of U.S. money supply growth. This has been dollar supportive as a result. Other factors equal, if the money supply is growing at a slower clip, the currency can be stronger. And indeed, this is part of the explanation there for why the dollar has been as strong as it is. But now think about that for a moment. If the flow of new dollars entering the world of investing, assets, it is slowing down, then you can't have everything rising in value at the same time. And so you find that the stock market has held up relatively well, and it's commodities that have really been taking the hit. Why is that? Take a look at relative stock market movements. It's really a U.S. story. The U.S. stock market is doing considerably better than other stock markets around the world. Why? Because those other stock markets are more dependent on basic industries, and they're more closely linked with emerging markets. What's really happening here is the BRICS are slowing down, and they're slowing down rapidly. Basic industrial demand and production in these countries is slowing rapidly. And it's not just the BRICS and the developing countries now. Again, Japan itself is really struggling to maintain its market share, and Germany has seen a material slowdown in its big manufacturing economy over the last 6 months. What commodity prices are telling you is that global manufacturing growth has slowed very dramatically relative to U.S. non-manufacturing growth, services, and that sort of thing. It's this disparity in the mix of growth globally which explains why the dollar is strong, why the U.S. stock market is holding up relatively well so far, and why commodities prices in general, it's not just gold and silver, it's everything, have been coming down very strongly over the past 6 months or so. But the idea that this can continue, that the U.S. can just decouple from the rest of the world indefinitely, it's wrong. History demonstrates it's wrong. It goes on for a period of time, and then the U.S. will find it's caught up in the same deflationary pressure that is spreading across the rest of the world. The U.S. in that environment will no longer be willing to tolerate this degree of dollar strength. The Fed will blink. QE4, QE5, QEX will follow, and the dollar will decline anew. Gold and silver will lead the commodities rally that ensues thereafter, and the relative underperformance of commodity prices relative to the U.S. equity market is highly likely to reverse. Now, I can't time this precisely, but I'm pretty confident that we will see this as the main sort of trend reversal of 2015. And in my personal opinion, it may, in fact, start before the end of this year.
That's interesting, because we've been predicting sometime around Q3 of next year is when we anticipate it kind of running out of runway with what's going on. But who knows? We will wait and see. John, we're up against our hard line, unfortunately. Great points, great conversation. We could go on, but we have to break. Any closing messages you'd like to leave to our listeners?
Well, people who are interested in learning about my investment philosophy and the specific recommendations that follow therefrom can do so. I do maintain a website at www.amphora-alpha.com. Amphora is spelled A-M-P-H-O-R-A. So my report archive is available there. Also, I do occasional podcasts, interviews, video, whatever it might be. You can just Google my name, Google my firm, and discover some of my other interviews, including this one, of course. But I'm also available by email. And if anyone would like to reach out and correspond with me, please do so. Also, you can follow me on Twitter at Butler Gold Revo.
John, thank you very much for the time. We've got to have you back. There's so much to talk about, and specifically, I'd like to spend a lot more time on commodities and gold and silver, because I know you're very, very knowledgeable in that arena, as are many. Talk to you again soon.
Thank you, Gordon.
Thank you very much. Bye.
Okay, bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.